Huge tax benefits of living in California and 8 other states. Count them, 8 other states. We'll get here in just a second. I did a video of this about a couple weeks ago, and I'm going to do it again because a lot of people don't catch all my videos. How double dog dare you? I had someone email me the other day, say, hey, Josh, what do you think? Yes, we'll say someone in Hawaii who's a nurse practitioner. Actually, is Hawaii one of the states? Hawaii is not one of the states that get the huge tax benefits. But anyway, she had emailed me and said, Josh, do you hear what Bo Jiden is going to do about step-up basis? And I said, lady, apparently you're not watching all my videos. I already did a video on this, lady. Come on. Step up, step up. You got to keep up. Anyway, so this is my man Martin Shankman. And I've been following Martin Shankman as a estate planning attorney out of Piscataway, New Jersey, or someplace in New Jersey for freaking probably 2 decades now. The guy just, man, when it comes to estate planning info, no one beats Martin Shankman. That's just all there's to it. The guy just freaking, I mean, Natalie Choate maybe, but she doesn't write, I don't think she has an ongoing blog the way Martin does. Anyway, this guy is just freaking, he's got a good video coming up too, by the way, which I'll share with you a link and you should sign up for about, what was it about? Anyway, we'll get back to that here in just a sec. Community property estate planning, not so simple. All right, again, California is the big one here. Let's just go through the 8 other states. We got California, Arizona, Idaho, Louisiana, Nevada, New Mexico, Tejas, Washington, and Wisconsin are all community property states. But Alaska, Tennessee, South Dakota, and perhaps other states have special rules that might provide similar or the same results as community property states. All right. Anyway, so we know the big 8. Big 9. Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Tejas, Washington, and Wisconsin. All right. If you live in a community property state, the 9 I just referred to, with your spouse, and if you had lived in the past, lived in a community property state with your spouse for any prior period of time, the assets accumulated there will have special rules that may have important impact on your planning. Ooh, that's hard. I don't know why I had a hard time struggling with that. But anyway, the assets accumulated there might have special rules that may have an important impact on your planning. That's a lot of PPPs. Example, husband and wife were married in a community property state and lived there for a few years. During that time, they invested in a hot tech stock. A few years later, they moved to a non-community property state and lived in that non-community property state for 30 years. And then they finally engaged an estate planner to help them. They needed to inform the estate planner that although they lived for many decades in the non-community property state, common law state, they had lived for a short while in a community property state, and while there, they made a small investment in a stock that is now incredibly valuable. The above example clarifies an important point that many people don't understand. Merely moving to a non-community property state alone has no impact on the characterization of assets acquired in a community property state. Those assets still have retained the community property. The above example illustrates how easy it is also to overlook an asset that may have community property characterization. All right, so let's keep going. Actually, significant income tax benefit from community property states or community property assets is that when the first of the couple dies, the surviving spouse should receive an adjustment to the income tax basis of the entirety property asset. Example, husband and wife live in a community property estate and own a rental property that's worth $1 million schmackaroonies, which they purchased for just $200,000. Remember, if you're taking depreciation, all that too, that reduces your cost basis, which increases your potential capital gains. So they're living in California. They got a rental property that they bought for $200,000. It's in San Jose. It's now worth $1 million. The income tax basis in that property is now 0. Husband dies, the income tax basis. All right, so remember the income tax basis because we depreciated. So they bought it for $200,000. It's worth $1 million. They depreciated it, and now it's worth 0. Big fat goose egg. So we have $1 million of capital gain. Husband dies. The entire interest in the rental property is stepped up to the $1 million. And if the wife sells the very next day, she pays no capital gain, no tax to pay. Example 2. Husband and wife live in a non-community property state and own a rental that is worth $1 million that they purchased $200,000 and is fully depreciated again. So the cost basis is 0. The asset value is worth $1 million. The income tax basis in that property is 0. Husband dies. Only half of the interest of the rental property is stepped up to $500,000. And if the wife sells the property the very next day, she'd have a $500,000 capital gain. Ooh, crazy, huh? So as is clear from the above discussion, the first step in determining the impact of community property on your estate and asset protection is identifying which, if any, assets are properly characterized as community property. If you lived your entire post-marriage life in a community property state, that might seem easy. If you moved in and out of different states, as your old buddy Josh, we moved to Texas, we got married in Arizona, we moved to Tejas, we lived in New Jersey, Georgia, Virginia. It was not Georgia, New Jersey, and Virginia are common law property states. Texas and Arizona are community property. I'll never set foot in California, but I have lots of cons to do. If you moved in and out of different states, some of which were community property states and others not, the analysis could be complicated. But even if you lived your entirety in your community property state, the characterization of premarital assets, gifts received, and inheritance may complicate the analysis. He gets into it more about gifts and inheritances, whatnot. You should provide complete information to your estate planning attorney. Yep, 100%. If you have an asset that is characterized as community property, you want to be certain that before you change the title or ownership of that asset, that you are deliberate in your decision. Characterizing a community property asset into non-community property will eliminate the ability to get the full step up in income tax basis in the asset of death of either spouse. So again, going back, let's see, maybe it gives an example. Yeah, right here. Husband and wife own the highly appreciated stock discussed above. They move to a non-community property state and have their attorney change the character of that stock ownership from community property to one half owned by each. That is referred to as transmuting the property and may be accomplished by a transmutation agreement. I don't even know what that is. Husband dies. Only half the value of the stock now gets the basis step up. If there's no other significant planning goal that justified changing the characterization of the property, they could have been better off not doing that, 100%. Leaving assets owned as community property may expose those assets to creditor reach that might otherwise occur. So again, basically, if you're saying, if I've owned half and Charlotte owns half, if Charlotte creditors go after her, they can't go after my half. It's not likely to happen, but that is an issue you have to contend with. If we have a community property, we both own it outright. So essentially, if her creditors come after her, they're coming after me too. That's worth, in my opinion, not a lawyer, talk to your own legal counsel, that is worth the community property for the 100% step up basis, 100%, especially if you got rentals and things like that, or some hot stock that you bought. Anyway, the point being is you definitely want to seek legal counsel here. And I would imagine even if your legal counsel is in freaking New York, they'd have to know about community property stuff. If you live from Arizona and move into New York, they would have to know this, I would think. I don't know, but if they don't, you say, hey, I got some community property. How does this jive? And if they're like, oh, I'm not sure, no big deal, I might go seek a different counsel. Anyway, this does apply to federal taxation. It's not just the state taxation, by the way. Just keep that in mind. All right, let's keep going. Apart from the general planning, I don't want to get GST, generation skipping trust. I don't want to do that. Let's see. What else here? Hold on. FYI, Martin gets deep into GSTs and using gifts. So husband, and I'll just read it to you because Martin, this guy just crushes. Husband and wife started a family business while married, living in a community property state. That one business is now worth 40 million schmackaroonies. Husband and wife have never made taxable gifts before. They want to use up all their current and GST exemption amount of $12.92 million each to lock it in before 2026. If they make these gifts before the exemption is reduced, they'll have preserved the entirety of the exemption. In contrast it if they only gifted half the exemption amount. When it's cut in half by 2026, they'll have no exemption remaining and will have effectively lost half the current exemption. All right. Lots of stuff, and Martin gets into lots of stuff, which I'll lead that to you. Are there step transaction considerations? That's well beyond my authority to understand. Another caution to consist with estate planning when it comes to community property. There's another aspect to potential community property characterization of the equity interest in the company that should be considered. Again, he's talking about $40 million business. I don't care about that. I do, but that's not for me. That's not for you. We're just more worried about our stock that we bought outside of an IRA, our rental assets that we bought outside of an IRA. Well, you get the house still has a $500,000 exemption anyway for if you're married. But still, anything that's outside of an IRA, you want to make sure is titled as community property, assuming other things work. And again, I'm not giving legal guidance here. You have to talk to an attorney on that. But my goodness, man, a huge tax benefit. I mean, just think if you owned a house, a rental in San Jose you bought in 1993, or Arizona. I got people bought rentals in Arizona in 2010, 11 for freaking pennies on the dollar. Arizona's community property, California's community property. Dude, make sure you have these things titled correctly. Go talk to a competent legal counsel. Say, hey, these things are worth $400,000 or $500,000 now. If I die, freaking Jackie over here, she gets a tax free. Upon Jackie's my wife. She gets a tax. I'm George and Jackie. George dies, Jackie gets a tax free step up basis. It's huge. Anyway, where else are you going to get this kind of information? Have you seen any other financial planner talk about this kind of stuff? The answer, of course, is no. I'm your man, dude. And if you like what I do and you find this to be supporting, and let's just say you kind of like my politics, dude, buy me a cup of coffee, dude. You're not getting this from anyone else. I'm the man when it comes to this. You're cocky. Doggone right, because I've been doing this so doggone long. All right, love your thoughts. We'll see you.